Welcome back to The Income Generation, the show where we provide information for the critical period in people's lives when they're either in or approaching retirement. Each week, I help you discover useful actions that serve to make this journey much easier. I'm David Scranton, your host. I look forward to this opportunity each Sunday to share with you insight and expertise that I use in my own investment management practice. Insights that you can either use as food for thought or decide to act upon while building or managing your finances, as well as the money you will need during retirement. Today on The Income Generation, we're focusing most of our attention on whether corporations, including those that you may be invested in, are too focused on short-term results at the expense of long-term shareholder or investor value, and how this can affect you, the income generation. First, let's discuss what's meant by shareholder value. To most analysts, myself included, it's the overall worth delivered to investors as a result of steps taken by management to grow earnings, to pay dividends, and to create corporate cash flow. In other words, investor or shareholder value is the byproduct of management's strategic decisions. These are steps they've implemented that have affected the company's success in producing net income and affecting share price. So how does a company's management impact its value? And why is it important to the income generation? Well, the best leaders are part visionary and entrepreneur, part risk taker and part negotiator. They know when to be hands-on and they know when to delegate. The right balance determines whether a company is incredibly successful or whether it even survives. For the income generation, focused on retirement goals, whether you're still in stocks or made the decision to rely on income-based investments, you don't have a short-term view. So it's best if the companies in which you're invested doesn't have a short view either. A company making decisions today that may steal from their strength in later years is not what's best for you. The problem CEOs face, even the best, is that many investors are short-sighted. So a CEO managing with an eye on long-term value at the cost of immediate stockholder gratification may see a decline in the price of the company's stock. The CEO has to contend with the idea that the average holding period of stocks 20 years ago was 5 years. Today, the average holding period is only 5 months. So managing to the long-term value when he has short-term investors may cost the CEO his job. The problem this creates is that corporations are ongoing concerns. If they're only focused on each quarter's numbers, then their decisions may not include important investments in things like equipment, short-term advertising versus long-term branding. Decisions that will make for a much brighter year after year, but will negatively impact profits this year. It affects whether they borrow to build or spend retained earnings instead. It also affects whether they pay dividends or buy back their own stock or make many other decisions knowing that they're being measured on how well they're doing today, not tomorrow. This is a real dilemma for corporate management. If decisions they make today steal greater profit from tomorrow, which road do they take? The answer very often lies in their incentive plans and other compensation, which helps guide their behavior. On today's show, we'll discuss the importance of this and even how to figure out which companies have a long-term focus. You'll discover why some companies are busy buying back their own stock shares and others prefer to reward investors with larger dividends. And most importantly, which is my advice for you, the income generation. These subjects are of particular importance to today's guest, and they should be important to anyone who owns stocks, bonds, or mutual funds. I'll be sitting down for a little Q&A during the News and Views segment for a conversation discussing the investors most affected by corporate myopia, and even those who stand to benefit the most. We can't really change what's going on in corporate boardrooms and corner offices, but we can change what we do to benefit from their decisions. Now, I want to be fair. Most heads of corporations are under immense investor pressure. A bright spotlight has been put on stock market values, so managers who don't excel under these tests tend to wash out. That is to say, a manager who gives up short-term gain for long-term results may simply find himself out of a job. It's the tortoise and the hare story, only with chief executives, and the tortoise gets fired partway through the race. Think for a moment about how it got this way. In 1792, When stocks were first traded on the New York Stock Exchange, few people were trying to build wealth by focusing on the business of others. They were focused on their own businesses, family farm, or their jobs. Information moved at a slow pace, almost unfathomable today. The fastest transfer of information was word of mouth, followed by letters delivered by rudimentary postal service. And for those who could get their hands on a newspaper, they saw only whatever the printer deemed worthwhile. Business information wasn't at the top of that list. Even a century and a half later, and with the advent of telephones, radio, and television, the news reports were not about the stock market. This allowed room for managers back then to manage the business with the goal of long-term growth and to maximize return on the resources. It's only been the last 40 years or so that technology and information has changed that focus. Today, even the average person is aware at some level of what the stock market's doing day by day. It was in the 1970s when people began paying more attention to the markets, in part because traditional pension plans were being replaced by 401k plans, and the introduction of mutual funds allowed easier access to many markets. Then when cable TV provided us with more than just 13 channels, new shows that focused only on business were created. At that point, the average Joe developed an appetite for knowing what the companies were doing. Following stocks and movements were suddenly mainstream, and for many became a hobby. Then the speed at which information was transmitted accelerated even more. The internet allowed on-demand access to information. No longer did anyone have to wait for tomorrow's newspaper to learn where their favorite stock traded that day. This caused greater participation and even broader interest. In fact, in the 1990s, when tech companies were creating millionaires out of stockholders, it became very common for people to discuss stocks at social gatherings. And many people became like the Monday morning quarterback, engaged in heated discussions as to which management should be doing what. And why not? If you traded the stock, you essentially had skin in the game. For many, owning a stock in a company is like having a bet on a football team. That bet seems to give permission to question every play the quarterback calls. What followed was online investing and day trading. The news decided to make celebrities out of CEOs and tell us when they missed quarterly earnings estimates, or they'd make other comments on how well they were doing their jobs. All of this attention affects day-to-day trading and the price of their company shares. So average investors may also be culpable when it comes to pressuring CEOs to think and act short-term. We've now reached a point with smartphones where we can watch the market tick by tick from almost anywhere at any time. We've learned as a society to become very impatient. That's a lot of stress and pressure on management, no matter how much they get paid. With an ongoing intense spotlight on share price, it would be difficult and perhaps career suicide for a CEO not to, at bare minimum, straddle the fence between good long-term management and short-term stock movements. Some do this quite well. Coming up next in the market breakdown, CEO compensation and why are so many companies buying so many of their own shares back, or what we're going to be discussing. Stay tuned. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Today on Market Breakdown, I present to you one of the most troubling causes of corporate myopia and one of its worst symptoms for income-based investors. There's been a lot of noise made in the last 8 years or so about high executive compensation. In fact, ever since the financial crisis, everyone from the media to the average worker is trying to find a villain. It's become fashionable to blame CEO pay. Typically, the protest and finger-pointing compares the total compensation of a big corporate CEO against the average pay of its employees. So in this market breakdown, I'm not going to discuss the price drivers of CEO pay versus every other worker. I'm going to talk instead about something much more relevant to you, the income generation. And that is why CEO compensation structure is a chief cause of corporate myopia. Also, we're going to discuss how top executive compensation drives management and therefore affects the long-term and short-term health of a company. as well as the company's credit rating and its stock price. To start, the board of directors hires a CEO and sets the compensation. The overall compensation of an S&P 500 corporate CEO typically has several components: base pay, short-term incentive, long-term incentive, employee benefits, perks, and severance, or what's called a change in control package. What may surprise some is that the most valuable part of a CEO's compensation is not usually salary. Instead, it's the short-term and long-term incentive plans on bonuses. These are typically a multiple of CEO salary. The salary, for IRS reasons, rarely exceeds $1 million a year. The part of their compensation package, which in my mind plays the largest part in the nature of their decisions, is short-term incentive. The second is long-term incentive, and then third would be change of control, or what's called the golden parachute. These are pieces that cause nearsightedness in terms of overall strength of performance. Here's why. CEO incentives are most often linked to how well a company's common stock does short-term. That's the short-term incentive. Most executive bonuses are heavily weighted toward year-over-year measurements of the change in share price. This often results in the CEO putting a large emphasis on year-over-year price movements in that company's stock. To affect this, that CEO may not act in a company's long-term interest and instead avoid long-term corporate investment or acquisitions, for example. Why? Because that might just dilute shares or diminish profit, even if it leads to longer-term benefits. The CEO might ignore other smart moves also, like divesting in facilities, because the one-time cost would affect this year's compensation, even if in the long run, the company more than makes up that cost and performs better. Remember, they're compensated on relatively short-term stock price movements. In smaller corporations, where it's an option, there is a trend today toward delisting the company from a stock exchange, for example. This provides management with luxury of basing strategies on longer-term goals instead of short-term goals. The clamor about CEO pay has brought about a greater emphasis on longer-term incentives. This helps keep the CEO focused a little bit more on longer-term strategic initiatives, but there's still one hitch. Most of that compensation comes in the form of stock-based compensation, such as shares that vest, options, or restricted shares, or even warrants. This still rewards the CEO for steps they may take to increase share price. Why? Because he or she probably owns a mountain of investments tied to the company's stock price. In today's low interest rate environment, a CEO may be tempted to take on more debt and then use that debt to boost stock value. Here's how that works. If the overall market takes a dip, for example, it's natural the chief executive will start to worry about their personal wealth. With low interest rates, what an increasing number of CEOs are doing is instructing their treasurer to buy back shares and finance it with money that's borrowed at low interest rates. This reduces the number of outstanding shares, increases demand, thus nudging their stock prices up. But the company's credit rating and possibly ability to be nimble later on financially might just suffer. This is not the kind of management a longer-term investor wants, especially a member of the income generation. Buybacks are one of the symptoms of myopic short-sightedness. Corporate buybacks for the S&P 500 companies were on the rise last year as the stock market was flat. In the third quarter, they rose over the previous quarter by over 14% for a total of $150 billion worth of companies buying back their own stock. In all, 73, or about 15% of the Fortune 500 companies, bought their own shares in the market over the previous 12 months. This reduced the outstanding shares in the S&P 500 index by 4% compared to the previous year. The main reason? Chief executives were taking advantage of low interest costs and borrowing to increase buybacks and reduce the supply of outstanding shares. That's longhand for decreased supply to help drive up stock prices. Now, this is nothing but smoke and mirrors because it serves to also increase their earnings per share. Earnings have been faltering for many of the S&P 500. The way the math works is they couldn't increase earnings, so they decreased the number of shares. This increases the earnings per share because there's fewer shares outstanding. It also helped bolster stock price, which is most of their compensation. There's been a long debate about whether stock buybacks create any value or if the practice is just a complete waste. Personally, I think if the compensation plans were different, there would be fewer buybacks and more dividend distribution. This, of course, would benefit you, the income generation. I'm going to be sitting down with Morgan a little bit later on the show to discuss the benefit of dividends versus stock buybacks. But first, I'm going to welcome my very special guest, a guy who can lend a great deal of insight into where value comes from. I think you'll all recognize his very special guest. Stay right here. We'll be right back as income generation goes one-on-one.
Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
I'd like to welcome my guest, Steve Forbes, back to the show. Last time I had Steve on the income generation, we had an encouraging conversation about his new book entitled Reviving America: How to Repeal Obamacare, Replace the Tax Code, and Reform the Fed, and how that will restore hope and prosperity. This morning, Steve, we're talking about corporate short-sightedness. We've been talking about decisions at the top levels of corporations that are often driven by what's best for the executives, not necessarily for the customers or even the long-term outlook for the company itself. But before we get to business, I want to tell you, Steve, that you make me feel like I'm back in Catholic school again. Do you know why that is?
No, I'm not wearing a nun's outfit, so.
No, you're not. Thankfully you're not. But do you have a screen there in New York in our studio where you could see me by any chance?
No. So I have to take you on your word.
Well, you see, I learned after our last interview what a gentleman you truly are. Do you have any clue why that is?
I sent you something?
Yes. You see, normally a host should be so grateful for having the guest that the host should send a gift to the guest. In this particular case, the guest sent a gift to the host. And I don't know if you've seen any of our commercials, but we've had a little fun with a commercial, Steve, where I talked about all the reasons why I will not wear a necktie on the Income Generation show. But I decided today was the day that I had to break my rule just for you. And if our camera crew could help me out for just a minute, I'd like you to zoom in here and take a look at the tie that was a very gracious gift from Steve Forbes. Written all over it, of course, the capitalist tool. And you, like me, I know, Steve, are certainly a capitalist. So let's
this makes you the best dressed person on the earth today.
That's right. That's right. I feel well dressed. Thank you very much. Listen, you know, we have the best system in the entire world in terms of capitalism. But what we're talking about today is the fact that it's not perfect. And first of all, I know you agree, but if you want to share in your own words for a moment with our viewers why you believe that there's a little bit of an issue, or at least a little bit of an issue, with corporate myopia in our country given our current system.
Well, I think what you see unfolding today, whether it's in the corporate boardroom or other aspects of the economy, is what happens when you have bad economic policies. The system doesn't work when you keep making mistakes, whether it's undermining the dollar, binge spending, regulatory tsunamis, which are especially harmful to small businesses. So people respond to the environment in which they find themselves. And today we don't have real free markets, as you know, and we've discussed this before. free markets, when allowed to operate, always turn scarcity into abundance. And we see that whether it's flat screen TVs, cost $10,000 or $15,000 a few years ago. Now it's a few $100. Smartphones, first one from Motorola, $3,995 30 years ago. Today, many plans will give the things away. Soon they'll be $50 if you want to buy them retail. Whole world at your fingertips. So when we look at what's going wrong around us, the origins, I think we have to get policies right, and then I think we can more successfully attack the shortcomings that we see out there.
Now, of course, there's been rumors in Washington where they seem to be trying to solve this so-called problem by curbing CEO compensation even more than it is currently. What effect do you think would that have if that ever made its way through?
Well, what you see in Washington often is what you might call the Washington version of whack-a-mole. They see a problem, they don't realize the origins of it, so they whack it, and then the more problems rise up. A good example, talking about CEO compensation, back in the mid-1990s, soon after he took office, President Bill Clinton decided CEOs were making too much money, so they put a cash cap on CEO pay of $1 million a year. And they wrote it in such a way that lawyers had a field day, but what that led to was then a huge emphasis on stock options, and we know where that led. So the key thing is, in terms of reining in rampant CEOs in addition to boards of directors, is this shareholder activism that we see out there. Not all of them do well, these activists, but they do put a little bit of the spotlight on what they think are CEOs who aren't performing.
I know your philosophy on taxes and capital gains taxes specifically, but for our one or two viewers that may not have tuned in the last time you were here on the show with us, tell us what you think a change in capital gains rates would do to this corporate myopia. Would it be a positive? Would it be a negative?
Well, if you did the whole thing on the tax code, and I think we're starting to get a real discussion of that, and junk the tax code and put in something like a simple flat tax, sharply reducing the capital gains levy or getting rid of it altogether, as some countries are doing now, you would see a wholly different environment. Right now, when you have a sluggish economy, it puts the emphasis on what you might call financial engineering, which is buying in stock, great for the shareholders, but not often the best use of capital. Mergers and acquisitions, sometimes they work out, but that's not the same thing as starting new businesses, really vigorously expanding existing businesses. So when you get a tax code that does not reward success, that punishes you if you start to earn more money, you get a distorted, deformed economy, and that's what we see playing out today. If you're on salary, given this current tax code, as you know, it is very hard to really accumulate capital. It punishes people who need all the removal of barriers, all the incentives they can get to move up the economic ladder. It's a rigged system, and it's rigged in a way where cronyism, who you know in government, soon counts more than what you do in providing things that people want in the marketplace, new products, new services, improving existing ones, making them cheaper, better, and the like.
That's great. Cronyism. I want to talk about that a little bit more after the break. We need to take a quick commercial break now. Stay with us. We'll be right back with more from Steve Forbes. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com. and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Welcome back. I'm here today with my new friend, someone who needs no introduction at all, Steve Forbes, author of the new book, Reviving America, How Repealing Obamacare, Replacing the Tax Code, and Reforming the Fed Will Restore Hope and Prosperity. Steve, see how simple it is? All you have to do is get me a simple gift, and I consider you a friend for the rest of our mutual lives. Isn't that amazing how simple I am?
Well, reciprocity.
That's right.
Makes for a much nicer world.
That's true. See, you put me on the spot here. Now all of our viewers know that reciprocity is what I need to provide at this point. Listen, right before the break, we talked about taxes, and you had insinuated that having a reduced capital gains tax or even eliminating capital gains taxes in other countries might actually be something that gets corporate CEOs and executives to focus a little longer term, but also even just having a differential between short term and long term. You know, if they pushed long term capital gains rates out several years, wouldn't that also help to a certain degree have people be a little bit less myopic in corporate America and a little bit more long-sighted?
Well, you have to recognize that people have different investment objectives. And some investors want to do companies that are starting to prove themselves. They want to hold them long term. Others just want to get them, especially in venture capital, get them out there and then take the money out, do an IPO, and then go on to the next one. So the one formula doesn't fit all. But one of the things that I think shareholder activists have to put more emphasis on is that CEOs have to do a better job of explaining what exactly is their strategy. Why should you put money in that company? The classic best example today is Amazon. Amazon made it very clear at the beginning, Jeff Bezos, the CEO, that they were going to pour every cent, every dime of capital they could get. There'd be no dividends. Profits were going to be skimped. They were going to pour everything they could to rapidly grow that company. So even though on the profit side, Amazon hasn't had much in the way of profits, Jeff Bezos made it very clear they're going to grow the top side, the revenue side, and go hell-bent for leather, as they used to say, and make that company a retail giant, innovating in terms of delivery and everything else. And occasionally when expenses got out of control, he pulled back, got expenses under control, and then went roaring ahead. So the fact they don't deliver much in the way of profits, investors know that, but they see the top line growing, they see the innovation coming, and so the stock has done extremely well. By contrast, for years, IBM was doing very well, and then went a little overboard on the financial engineering, using all their cash to buy in stocks. So even though the top line was not doing well, they showed a good bottom line, but it was short-termism. So shareholders have to, CEOs, part of the obligation they should have is putting out there what are their objectives, what are their metrics, what should you expect? And you see this really, David, in healthcare. A lot of these startups, they'll tell you for a while it's just going to be absorbing a lot of cash as they develop a couple of new drugs or medicines. And if it hits, you're going to do very well. But in the meantime, you're going to know it's going to require a lot of investment before this thing can be brought to market.
I think that's an important point, because when you talk about all the financial engineering, you could financial engineer the bottom line, the profits, but you can't financial engineer revenues. You can't fake it. Either revenues are coming in or not. How about if somehow that if bonuses were tied more closely to the top line? How do you think that might change the motivation of today's CEOs and management teams?
Well, this is where it gets to be not a science but an art, and this is where the compensation committees on boards of directors need to be held, have more of a spotlight on them. And that is, if you're going for growth, okay, good, grow the top line, but don't do so in a way where your expenses are going to end up undoing the company. And that's what Bezos has been, Jeff Bezos of Amazon has been very good at, making sure that the top line grows without wrecking the company. And so you have to have various metrics in there to be sure that focus on one thing doesn't come at the expense of everything else. And this is where startups often get in trouble. They see, sales are doing very well, but they lose control of their cash flows. They don't do that very well, and boom, they're successful, but they go broke. They don't understand why.
Sure.
So you got to tailor it to the specific company. And that's what we need more of, this kind of fine-tuning. What are the proper metrics for the company at that particular time?
I agree completely. You'd mentioned before the break, cronyism was the word that you'd used, and some call it special interests or lobbyists. And in this political year, I know you're no stranger to politics, so in this political year, what do you think could be done to help solve this problem from the special interest side, the cronyism side?
Well, in addition to more transparency, the key thing is, and this is a mantra that we haven't been very successful in enacting, is make government smaller. If you have a large government that becomes more and more involved in more and more aspects of our lives, more and more businesses, I mean, whoever would have thought that Washington now would be trying to control the internet the way they did dial-up telephones back in the 1930s. It's really starting, it's going to be a real dampener on the growth of the internet in the future, where you got to get permission if you want to start a website and that kind of thing. And when you have that kind of more and more regulation and that kind of top-down attempt to control people, you're going to have to lobby Washington. Otherwise, they'll kill you. You reach a certain company size in this country, and if you don't have lobbyists in Washington, the political class will come and exact tribute from you. They will come and get you. It's a hideous system we're developing today. So that's why we got to pare back in government, not safety nets, but this regulatory blizzard that we're going through now, where they're trying to control everything we do. You get up in the morning, they want to tell you what to do, and it's ridiculous, but they'll do it unless they're stopped.
Great. Well, you heard it straight from my new friend Steve Forbes. Smaller government, not bigger government, is the answer, and I think most of our income generation viewers would absolutely agree. Once again, it's been a real pleasure.
By the way, a good way quickly, David, to think about it, if you complain about mosquitoes, drain the swamp. That's how you get rid of the mosquitoes.
That's right. Solve the problem, not the symptom. Agree completely. It's been a pleasure having you on the show once again. Thank you.
Thank you.
And now you have the entire income generation holding me accountable for my new word of the day, reciprocity. So stay with us. We'll be right back after the break, where Morgan and I go one-on-one to talk more about corporate myopia and maybe even come up with a solution or two beyond what you heard today from my new friend Steve Forbes. We'll be right back. Stay with us.
The closing numbers on the markets today, at one point the market fell as if down a well, over 700 points.
Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Finally, there is an alternative. Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Plan with confidence, knowledge, and peace of mind. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
We've spoken a lot today about short-sighted companies and why they seem to be managed with only the immediate future in mind. Now I'm going to talk about just one more critical problem with companies that focus on the short term, and then before we run out of time, we'll talk about what investors can do about it. There are short-sighted, and I'll even throw in cold and heartless companies that knowingly release a product that could turn into a disaster. They're aware of it, but ignore it anyway. The most recent example of this, of course, is Volkswagen. If you're not familiar, last fall there was mounting evidence that Volkswagen had intentionally added a computer program on at least some of its models to defraud emissions tests. Eventually, the EPA discovered that 482,000 Volkswagen diesel cars in this country alone were emitting up to 40 times more toxic fumes than permitted by law. 40 times! Volkswagen sold these cars knowing they had emissions problems, but instead of taking the far-sighted plan and fixing it, which would have reduced immediate profit, they reprogrammed the computer to trick the emissions test into thinking these cars were within the right range. Now, fast forward a few months, and Volkswagen not only faces public relations problems, they're also considering footing the bill to purchase back more than 500,000 cars. Additionally, they'll probably be hit with lawsuits related to health and safety issues, costing many times more than if they were future-oriented and didn't cheat in the first place. The same has been true of many other companies. Over the years, you remember the Ford cars and trucks that caught fire, and the Firestone tire blowout issues. Well, there's a host of chemical companies, paper producers, restaurants, and pharmaceutical giants that saved a small amount in the short run, but paid dearly down the road in the long run, all because of corporate short-sightedness. This is corporate myopia at its worst, and I'll emphasize it costs shareholders and costs management their jobs, employees their pensions, and ruin the health of customers. In some cases, the so-called cheating has put the company out of business. So the question becomes, what can you do about this corporate myopia? I'm not sure there's a perfect way to defend yourself from outright fraud, corporate cheating, or management simply turning a blind eye to problems that will cost them down the road. This is really a problem of oversight. Investors should pay more attention to who's put on the board of directors, for example. Admittedly, that's not always easy. The first place that the income generation can benefit from corporate myopia is if you're going to be in the stock market at today's near record highs, you at least can put yourself in a position to collect high dividends from highly rated companies. If a corporate CEO has been in place for a while and they've paid a consistently high dividend, it may be worth just taking a bit of a deeper look. You can find executive level compensation information of any public company by going to the sec.gov website. The analysts at my company, for example, Sound Income Strategies, also like to look at dividend growth. They like to look at low debt to equity ratios and a high ratio of short-term assets over short-term expenses, i.e. a lot of liquidity. Another favorite ratio of analysts is what we call the coverage ratio. This applies specifically with fixed income, bonds, and bond-like instruments. This measures how many times a company can cover its annual debt expense relative to its cash flow. But with all of these, in the end, even great numbers may be ignored and the company overlooked if we discover a management compensation package that rewards this short-term sided decision-making. For investors looking at bond yield, it helps to determine if the company is going deeper and deeper into debt, and to try to determine what the bond issuance proceeds are actually being used for. If a company continues to mount debt, eventually it can get downgraded by a rating agency. If the economy or the related industry is hit with hard times, it could even miss payments on debt obligations. Remember, leverage is a double-edged sword. The benefits of borrowing for any reason can magnify the outcome, whether the outcome is good or the outcome is bad. There's been a huge push recently to help fix corporate myopia problems by linking the company's debt costs in the CEO total compensation package. What this would accomplish is align the CEO's interest exactly with that of you, the income generation. Linking the two together could incentivize them to steer away from taking risks that might cause downgrades or eventually alienate creditors. Another method that's becoming more common is preventing executives from dumping personal shares until several years after they're granted to them. This could give them a better reason to think long-term if they are forced to hold their shares long-term also. Other compensation packages strive to be even more fair to everyone involved. These agreements include share price movements relative to the overall market, for example. If the stock market is weak, the compensation package may allow for weaker results. This helps in two ways. First, it doesn't encourage the CEO to take missteps to nudge up prices. And it doesn't cause the CEO to just give up because the goal is impossible and out of their control. Measuring market moves against company moves will ensure that managers' interests are more closely following those of the company and you, its shareholders. As always, the Income Generation is here each week for you. As new ideas and other important information needs to be disseminated, you'll get an in-depth look on our show. Sound bites often create more confusion for viewers, so I leave that kind of reporting to others. We've gotten some great suggestions on subjects you'd like us to dig into. All good ideas, all ideas we hope we can get to throughout future shows. Keep them coming, please. I'd like to thank my guest for spending time with us today, as his insights are pure gold to this and almost any other audience. Also, I'd like to thank Morgan with her questions on how dividends are superior to stock buybacks most of the time. I want to thank each of my viewers. I'm glad we have this time together each week. I invite you to head to theincomegeneration.com and let us know just a little bit about yourself. Well, that's all the time we have. I'll see you all again next week.